Good evening and welcome to this session of the live virtual classes conducted by the Board of Studies of the Institute of Chartered Accountants of India. Today, we take up a topic. The new topic is share capital and debentures. So I'll give you some of the highlights of the topic. Then you can definitely raise questions and queries and all that based on your requirements. So we already saw a little bit of this in preliminary when we defined share. What is a share? Right? Now we are going to go in depth into share capital. We also saw the types of share capital and all that. So we won't waste our time on that here, but rather we will talk about how to increase capital, how to reduce the capital, buyback, etc. The sections that we deal with are 43 to 70 deal with share capital. Just one section, 71, deals with debentures. Okay. This is a conceptual chart. As I told you the other day, the capital, when I was talking about shares in preliminary, we said the capital of a sole proprietor is a nebulous. You see, it has no shape. It has no shape. It is shapeless. It is shapeless. It keeps changing. As and when profit is added, drawings are made. Even the capital can become negative, right? Why? Because this is very important for you to understand. The capital of a sole proprietor is not indicative of his solvency. For example, if the capital of a sole proprietor in the business balance sheet becomes negative, it does not mean that the sole proprietor is not liable. It means you can always attach his personal assets, which are not reflected in the balance sheet of the proprietary business. Even though it is not reflected in the balance sheet of the proprietary business, you can attach it, you can take over it for a sole proprietor. Same way for the partnership also, even though it is not in the partnership balance sheet, if it belongs to the partner, the personal assets of the partner can be attached for the liabilities of the firm. This is because the sole proprietor and the partnership, the normal partnership, not the limited liability partnership. LLP, it will be different. For LLP, liability of a partner is limited. But for a non-LLP partnership, the liability of a partner is unlimited. Means he must pay as much as is due. His personal assets can be taken. Whereas the minute you come to a company, then the company's share capital is divided into fixed units. So you can see the formation here now. It's like a grid with vertical and horizontal lines, and each small square is a share. The value of face value of the share is fixed. So we have a company has 5 lakh shares of rupees 10 each. So 50 lakhs. So this is exact. So if I buy one share, I have to pay 10 rupees. You have to pay 10 rupees. In case the company's value has gone up, the market is willing to pay you a premium, then a 10 rupee share may be quoting at 30 rupees, 20 rupees premium. Whatever it is, the basis for calculation is the unit, which is the value, face value of a share. Now, this cannot change. This cannot become negative. This is fixed. Very important. Why I make this point very vehemently? Because this amount cannot be touched except on rare circumstances. Debiting share capital is a rare occurrence in the accounts of a company. Rarely you will find share capital is debited. For example, you have buyback when share capital is debited, or redemption of preference shares when preference share capital is debited, or forfeiture of shares when share capital will be debited. But again, when it's reissued, it will be again credited, right? Rarely you'll make these entries. Finally, winding up. At the time of winding up, when the entire capital is repaid or written off, the amount will be debited. Whatever it is, until one of these events happen, you cannot reverse it, you cannot reduce the capital. Okay. Now, this point will become very relevant to you going forward when we come to buyback, etc., reduction of capital. Point again, we have to understand. The capital of a company is the only amount available to the creditors. Or if at all, if it is partly paid shares, then to the extent of the amount, if any, unpaid on the shares can be collected from the contributories in the time of winding up. That is all. Otherwise, the creditors have to only look at the balance sheet of the company. Whatever assets are mentioned in the balance sheet, only those are available to the creditors. That's why all assets of a company should be held in its name and it should be reflected in the balance sheet of the company. There should be no asset belonging to the company which is not in the name of the company, right? Shares are divided into, share capital itself is divided into two broad categories. You got equity share capital and the preference share capital. Basically, the equity share capital holders, the equity shareholders are the owners of the company, are the owners of the company. They are the people who run the company and they finally, loss or profit, it belongs to them. Preference shareholders are also equity, that is, they are also part of the shareholder group. Their share capital carries a preferential right. So if you are a preference shareholder, you will get your dividend first. There is a preferential right with respect to payment of dividend, and at the time of winding up, before the equity people get paid, you will get paid, right? I'm not elaborating more on preference share capital because you would have studied it in an earlier sessions, for that matter, in foundation or in entrance school. So I don't want to waste your time on that. But if you have doubts, you can always raise it during the doubt clarification session on preference shares. Of course, we might see redemption of preference shares, but basically, what is a cumulative preference share? Or what is non-cumulative, cumulative, participatory, non-participatory, redeemable, irredeemable. All this I don't want to waste your time. Suffice it to say, preference share capital has a preferential right. Therefore, they get paid first. The dividend, once the company declares dividend for the equity, before they pay the equity dividend, they have to fully pay the preference dividend. Only then the equity gets dividend, right? Now, equity shares, again, are divided into two categories. One is called normal, with voting rights, with full voting rights, we should say. Instead of saying with voting rights, I should say full voting rights. Means, friends, voting, V-O-T-I-N-G, voting for a company is very different. In the case of a company, initially, suppose you have a meeting, a general meeting. See, don't have confusion. Board meetings, alag hai, general meeting, alag hai. So don't get confused between the two. If you get confused, go to the corner, get confused and come back. But there is no need to get confused. Board meeting is when board of directors meet, that is called board meeting, majority. When shareholders meet, it is called general meeting. When you come to management and administration, I'll tell you more about it. Okay. In that general meeting, you may have to pass either an ordinary resolution or a special resolution. How will you know when to pass which? You have to study the section. Each section has clear-cut norms. Yesterday we saw, in the last class we saw. You have to remember how, maybe make a tabular column. I said, what I normally do is, see, it's actually not difficult to remember if you study with concentration. Broadly, maximum it will be, you should remember the special resolutions. That's easier. In fact, you can even make a chart in your syllabus. What are all the sections which require special resolution? As you make that chart, automatically you'll remember it. For example, amendment of memorandum, name clause, change in the name of a company, situation clause, amendment of object clause, any amendment to memorandum, amendment of articles. When you want to divert a when you have collected money from the public and you want to use it for a purpose other than that stated in the prospectus, like that. So once you are able to write this down, automatically you'll remember it. It's only when you're mugging up without understanding that you will be in trouble. Don't do that. Try to remember, write down, make it into a chart, become easier for you. Of course, ready-made charts are available on Google. You can just go there, matters requiring special resolution. I'm sure somebody would have done it for you already. But creating your own chart will make you more knowledgeable of this. This is something you have to take from me. This is what I used to do. I used to have charts. And as I prepare the chart in my own handwriting, yeah, I remember. That's how it happens. Okay. Somebody was asking how to remember. I think Mr. Akash was asking how to remember. The only way to remember. If you know any better way, please patent it and sell it because it will be very valuable. This is the best way. But if you have discovered any better method, directly, you put a small hole in the forehead and put a pipe and then pour the whole knowledge into the brain. Such things are there. Then otherwise, the only way we know is read, remember, write, read, remember, write, read, so that it becomes a cycle of memory. That is the only way short-term memory can be improved. There is no other ways. Even the greatest psychologist will tell you short-term memory. See, this is called short-term memory. What all you are now studying for your final exam, no, it's going to be only in your short-term memory. To become regular, full, long-term memory, you should have worked more with it. So, but that short-term memory, if you do this, your short-term memory will improve. And till the exam, believe me when I say this, your brain also knows how long it's need to be retained. Believe there are many cases where after the exam, 1 week later, you'll forget everything. Don't forget, the brain won't give it importance. To bring it out again, you have to again read it. So once you work with the memory now, you will understand what I'm saying. So my best suggestion is instead of keeping on asking everybody you meet how to remember, start writing down and start read, remember, close the book, write, then open the book, compare, correct the mistake, done. 3 days later, again, write or tell from memory, like that. Okay, sorry I know I'm making it sound very boring for you. If you know any better method, quick methods and all, sorry, many people will claim memory techniques and all. Once you go to the class, you will realize that basically he's talking the same thing I'm talking about. And again, some people have memory, some people don't, is there, of course. For example, my son has photographic memory. If he reads a piece of text, he can read it. He's an advocate. So straight away remember. Not even I don't have that ability. In which case, what happens? We have to work a little harder. We have to read a little more. We have to write. That's all. So that effort you have to take. If you have a natural memory, good. If you don't have natural memory, little effort is needed. If your memory power is very poor, then CA, I don't know how far it's going to be because this examination needs a certain degree of memory capability because it's a closed book exam. Therefore, it has to be here for it to go there. If it's not going here, then check up what to do about it. Okay. My grandmother used to say, if you take curd and mix it with sugar and eat every day, memory will improve. Try something like that. Okay. Has any Indian company issued shares with differential rights? Equity shares, full voting right. On the meeting of the company, one man, one vote initially. One man, one vote. So if I raise the hand, voting is by show of hands. Raise the hand. But the minute a poll is demanded, P-O-L-L, poll, pronounced as P-O-L-L, the same way you pronounce P-O-L-E, poll. P-O-L-L, poll. Normally we pronounce it as polling. What recently when you went for your general elections, we call it polling booth. What do you do there? You go and exercise your voting right. How? You press the button for the party which you wanted to vote. Similarly, in polling also what happens? Everybody will get a polling sheet. In the polling sheet, the resolution will be printed and for or against, yes or no. Now, so once the polling happens, automatically, please note what I'm saying. Remember, on poll, one share, one vote. See how the minute a poll is demanded, the equation changes. When we come to management and administration, I will tell you in more detail. But since we're talking about voting rights here, I want to stress it. See, I'll give one simple example, you will understand. There are 5 shareholders in a company. Sir, 5 shareholders. 4 of them together hold 40%. 4 people together hold 40%. One person holds 60%. They attend. One man holding 60, the others 10, 10, 10, 10, 40 plus 60, 100. They vote. Voting by show of hands. 4 people against 1. Obviously, motion. But before the voting result is announced, this one man stands up and says, this fellow has been elected as chairman by these 4 guys. We will elect him as chairman. Whatever. Whoever is the chairman elected on show of hands, the first on that matter itself, this fellow is demanding a poll. So he said, Mr. Chairman, I demand a poll for election of chairman. Sorry, whoever was elected on show of hands will have to conduct the poll. And on the poll, whoever is elected will take over as chairman. Now, on show of hands, 1, 2, 3, 4 is to 1. But on poll, what happens? 60% versus 40%. Now, simple majority, who will win? Always this guy will win. Simple majority, number of votes cast in favor exceeds number of votes cast against. 60% guy will always win. On a poll, majority will always win. Ordinary resolution, majority will always win. So, polling is when one share, one vote. So, this is a normal full voting right. Now, in differential voting right, what happens? One share may not carry one vote. For example, 5 shares together may carry one vote. But obviously, because I am foregoing my voting right, I will get higher dividend. See, for example, Tata Motors and Pantaloon Retails, these are the 2 companies, they issued DVR, means differential voting right shares. 1/10 voting right, meaning what? 10 shares, 1 vote. So if I have 100 shares, if you are a normal equity shareholder, if you have 100 shares, you'll have 100 votes. Whereas I'm a DVR holder of Tata Motors, I have 100 shares, I get only 10 votes, 1/10, 1/10 voting rate. But in exchange for this, they get 5% higher dividend. Suppose Tata Motors declared dividend of 18%. Normal equity shareholder will get 18%, whereas I will get 23% because I'm foregoing my voting rights. This is called differential rights or differential voting rights, sometimes abbreviated as DVR share. Okay. For a company to be able to issue equity shares with differential rights, certain conditions are to be satisfied. So one is there should be an authorization in the articles. Then there should be an authorization by an ordinary resolution. See, it says here no ordinary resolution. So immediately you should write down issue of equity shares with differential rights, ordinary resolution. Okay. In case the company is a listed company, it has to be done compulsorily by postal ballot. See, what happens is in a postal ballot, shareholders get a better chance to vote. Suppose they hold a normal meeting on a weekday, that too on Monday morning, 10 a.m. How many shareholders can come? That too Nariman Point in Mumbai. My register office is Nariman Point, Mumbai. How many people can come? Hardly. So, of those who come, if I get a simple majority, it is enough. Always remember, those who are present and voting, only that will be counted. So those shareholders who sit at home shaking their leg, nothing is going to happen. Whereas, if it is a postal ballot, what happens? It comes to my house. I can open the cover, mark my answer, fold it, paste it, self-addressed envelope, I can post it. I can exercise my vote. I'll have 30 days to do this. That is postal ballot. Or you can do e-voting also. Nowadays, they permit you e-voting, where you have a normal, we'll come to that. When I come to management administration, I will tell you about that. Why postal ballot? To give more power to the shareholders to exercise voting right or to give their a chance to deny. They can vote against like that. This is only for listed companies. Okay, this is the point. Friends, there is a query pad available. I don't know if you are aware of it. As and when you are having any doubts as I am talking to you, you can raise the query in the query pad. I will answer that also. Okay. But if you, one thing, please remember, if you raise a question in the chat, I may not be able to see it. I may not be able to see it. So kindly don't put in the chat, put it in the query pad, which I am able to see. Later on, if at all you put it in chat, I can't take it now. I'll take it later. But right now, I'm looking at Ms. Garima Kushwala's message, which says, Namaste, sir. I started preparing late. This is my first day. How to cover? I don't know which exam you're writing. If you're writing in September, then you are not late at all. You're well in time. And see, the entire lectures on company law are available on a video format. It's the links are with you. So you systematically plan a timetable, go there, you click on the link, dabaye, then you go there to that video, watch it, take notes, keep the institute material open. Listen to me for that, you one revision over. Then if you have any questions, attend for these classes, raise the questions. We will clarify it for you. So this is the new pattern of the Board of Studies. So the already pre-recorded lectures are available. You just have to go there and download it. I mean, sorry, you have to just go to the link and see it. It will take a little time, 2.5 hours. For example, this topic would have been taken across 4 sessions. So about 10 hours of running time will be there. You can fast forward. Suppose I'm talking some nonsense, you can fast forward it. Then go to the topic. Use your discretion. You don't have to watch the whole thing. And keep the institute material so that you'll get a lot of inputs. Then that's it. So this is how I will do it, ma. So if you keep on asking me how, what can I do? Somewhere you have to jump into the water and start taking bath. If you keep on standing in the corner of the tank and saying, I will take bath, when you will take bath? You'll never take bath. Plunge into the water, start bathing. That's it. That is the only way out of this. That is a commonsensical approach. Simply saying, I'm starting late, early, nothing like that. You have your own timetable. It is all self-paced model. Even for intermediate, you can pace it yourself. Whenever you want to watch the video, watch it. These classes are not complete classes. They are only doubt clarification and sort of revision type of, even revision, highlights of the topic types. And you can raise queries you want. Okay? Not many topics have been covered. You are very much there. Don't worry. Kindly don't put any queries in the chat as of now. Put it in the query pad. Please. So there should be authorization in the articles. My notes, I don't know. They were all uploaded. They are available in the boss portal. I don't know. Maybe later on, I will again send it. I will send everything again once to the board of studies. They can upload it for me. Just send a mail to the board of studies. They will guide you on what to do on this. Okay. These PowerPoint presentations in complete, the complete PPTs in PDF form are available. Okay. So kindly do it. So now, this is a very peculiar condition in number 3. Do you see that? Voting power of all shares with differential rights not to exceed 74% of total voting power. To understand this, you should understand what is total voting power. See, total voting power is defined as if on a poll, all the votes are cast, whether for or against, how many votes will be cast? That is the total voting power. See, in my example, let us say, I told you, 5 shareholders are there, right? Let us say that this company has 10 lakh shares. 10 lakh shares. Now, so out of 10 lakh, 10, 1 lakh, 1 lakh, 1 lakh, 1 lakh, 4 lakhs. This fellow has 6 lakhs. So, together the total voting power is 10 lakhs. Because if all of them vote for or against, how many votes will be cast on a poll? On a poll, 1 share, 1 vote. Therefore, 10 lakh shares, 10 lakh votes. That is called total voting power. The total number of votes which will be cast on a poll if all the votes are cast, whether for or against. Okay. So, in this example, there are 10 lakh shares, then 10 lakh votes, right? So here is an example I'm giving you to help you understand. What did they say? Once you issue DVR shares, voting power of all shares with differential voting rights should not exceed 74% of the total voting power. So let us look at this. Here is a company. It has a normal equity shares, that is full voting shares, 1 lakh. Equity shares with DVR, 6 lakhs. Now the DVR shares have 1 vote for 2 shares. So if I have 2 half vote, basically half vote. So on 6 lakh shares, I get only 3 lakh votes. Now what is the total voting power? For the normal equity shares, it is 100. For the DVR shares, it is 3 lakhs. Why 3 lakhs? Because though the number of shares is 6 lakhs, they get only 1 vote for 2 shares. So if at the time of voting, all of them vote, if all these guys vote, it will be 1 lakh shares. If all the DVR shares vote 6 lakh votes, for 6 lakh shares they vote, still they will be having only 3 lakh votes because for each 2 shares, they'll get only 1 vote. All right. Now, what is the total voting power? Yeah, be careful. Total voting power is 1 lakh plus 3 lakhs, 4 lakhs. 1 lakh plus 3 lakhs, 4 lakhs. Okay. Now, out of this, how much is the voting power of equity shares with DVR? 3 lakhs. What is the percentage? 3/4, which is 75%. So it cannot be, because the voting power of all shares with differential rights not to exceed 74%. So they should reduce the number of, they can't issue 6 lakhs. That's all. If the question in the exam says, can they issue 6 lakh shares with 1 vote for 2 shares? You will do this computation and come to the conclusion, since after issue of the differential voting right shares, the shares with differential rights, the voting power of all shares with differential rights will exceed 74%. They cannot issue 6 lakh shares. Maybe something less, so long as it doesn't exceed 74%. Right? Now, I know this is a little bit of computational thing. So if you have a doubt, my suggestion, you ask me now. Okay. If you have a doubt, you can ask me. Or later on also you can ask me, but if you ask me now, it will be better. Here and then and there, this is something. And yeah. Okay. Now, there are other conditions also. No default in filing financial statements and annual returns. This is a very important condition. That whatever else you do, please file the financial statements in time within 60 days. File the annual return in time within 30 days. Because the MCA is very concerned about this. They want you to do that. There should be no default in this. Okay. Many activities or many exemptions are available only if you do this. They are saying you are a basic defaulter in filing financial statements and annual return. Why should we even consider you as a human being or as an entity? Go like that. Similarly, why such condition? Because you see, the company should not issue too many DVR shares. See, they are saying DVR shares, if they issue, what will happen now? The fully paid shares will be less, whereas the lesser the DVR shares will be there. So they are given 74%. They could have had it lesser also. They have selected an arbitrary number 74. The question why is there, but even I am unable to answer. Why up to 74 they are permitting, 74 they are permitting. Okay. See, from now onwards, this company cannot issue DVR shares. This is the limit up to which. If they want to issue DVR share, what should they do? Suppose this company wants to issue more DVR shares, what should they do? They should increase the normal equity shares. So the idea is the normal equity shares should not fall below 26%. Minimum, they're saying equity shares with normal voting rate should be 26%. It's more of a minimum condition for normal equity shares. So that if you want to maintain this DVR, you have to increase the normal equity shares. See, there are two ways of doing it. Either you can reduce the DVR or you can increase the normal voting shares. Am I correct? Suppose you issue 1 lakh more normal equity shares, what will happen? Your total voting power will become 2 lakhs plus 3 lakhs, 5 lakhs. Now on 5 lakhs, you'll have 3 by 5. Am I correct? Which is definitely lower than 74%. So, I think the purpose is to ensure that there are at least some minimum number of normal equity shares. Good question, Mr. Anu. But one more thing, yeah. Other than these two companies, no other company has issued, no company is interested in issuing DVRs. Though, if Reliance comes out with the differential voting rate share, believe me, will buy. And one more thing, the differential voting rate share will be otherwise having the same rights as the equity shareholders. So there should be no default, repayment of matured deposits, redemption of debentures due for the same. Similarly, redemption of preference shares, payment of interest on debentures and deposits. Everything should be done correctly. No default in payment of preference dividend. Repayment of term loan with interest thereon to any public financial institution, state level financial institution, scheduled bank, okay, etc. All these are, there should be no default. Provided, see, in these cases, there should be no subsisting default. Meaning, suppose there is you have not repaid your matured deposits. Once you repay the matured deposit, immediately you can issue your DVR shares. But in case there is a payment of preference dividend, you have not paid, there is a default in payment of preference dividend. Even if you pay it for 5 years, you cannot issue DVR shares. Similarly, if there is a default in repayment of term loan, you make good that deficit, you pay the term loan in full to the PFI or the state level financial institution or scheduled bank. Even then, you cannot issue DVR shares for 5 years. Only after the expiry of 5 years from the end of the financial year when default was made good. So let us say that you had some old preference dividend was still payable. You paid it during this year. In June 2024, you are paying. Then for the end of the financial year will be 31/3/25. So from that period, that means 26, 27, 28, 29, 30. Till 2030 March, you cannot issue DVR shares. Okay. Similarly, the company has not been... see this. Please tell once more if you want to do. At least you should tell what you want to tell once more. Madam, Ms. Adira, VP, if you are telling, please tell once more what you want to tell once more. Which part of the topic you want to tell once more? This once more 3 times, if you want, I don't mind doing it. But which one you want? Please tell. Mohammed Sohail, if you have already attended my class, don't attend now. Why wasting your time? Already you have gone through the torture once. Why undergo one more time? If at all you want to do it, the video lectures are there. This is only a part lecture. The full topic is being covered in the link. Go to the link, see the entire video for your thing. Okay, so no need to see how many times you will put it. Yeah, Mohammed, I know how in those days also you used to irritate me by putting it again and again and again, thinking that I have not seen it. When I'm taking the topic, I can't interrupt my lecture and reply to you. Okay, you have something. So don't waste your time. Go and study some other subject. If at all you want to study, go to the link and watch it. If you have any doubts, use this class to raise the doubt. Just come into this class, raise the doubt so that I will clarify it for you. If you're doing some revision using my original lectures and you have a doubt, genuine doubt, or maybe you solved a problem and all, there are 2 ways of doing it. One, if it's an complete problem, you put it in the query pad. I will refer to the problem, and if you have a specific doubt, ideally with folded arms, ask a specific doubt. Don't say, I don't understand anything. If you don't understand anything, what can I do? I don't understand this. No. Say which part of it you don't understand. Which is the... Then I will clarify that for you. So it can be done. You can use these lectures for that type of revision rather than fully attending. Or if you want revision, just come there and revise. You can come and you can have a good revision. Okay. So Moving on. I think it got saved. Yeah. So for 5 years, you cannot issue. Is this what I want me to say again? I will tell. If this is what you want me to say again, I will tell again. See, there is a default in repayment of term loan. You pay it, you finally settle the term loan this year. No, you want to issue DVR this year? No, you can't. Next year? No, you can't. When you can issue? Only after the expiry of 5 years from the end of the financial year, when the default was made good. The financial year when the default was made good was 24-25. So from 1/4/25 onwards, you count 5 years. 26, 27, 28, 29, 30. So 31/3/30, only 5 years will get expired. After that only for these two defaults. Whereas here, the minute you paid and the default is not subsisting, immediately you can go for DVR. Right? Remember the distinction between 6 and 5. No subsisting default. Here, no default and expiry of 5 years. Okay. Similarly, the company should not have been penalized during the last 3 years under the RBI Act, SEBI, SCRA, FEMA, any other special act. For example, PMLA, whatever. Prevention of Money Laundering Act, which is not in your syllabus now. But money laundering is there, but the topic is not there in your syllabus. So the company should not convert its existing equity share capital with voting rights into equity share capital carrying differential voting rights. Okay. You cannot, means if you already have equity shareholders, no, you cannot. Though, of course, you can have variation of shareholders' rights, but variation cannot amount to converting it into differential voting rights shares. No. Okay. The holders of equity shares with differential rights shall enjoy all other rights, such as bonus, rights, everything you are the same. Everything you are the same. In fact, for dividend, you'll get a little more. And at the time of selling the share, you'll get the same price. See, think about it. If Mr. Mukesh Ambani tells me, Srikanth, you won't have any voting right in Reliance Industries, well, you can get the share. When I'm declaring dividend, I'll give you 6% more than the others. Say, Salam ji, and I'll take it. Because what is the use of that voting right in Reliance? Yeah? Crores of shareholders, crores of shares. I am one among them. What am I going to do with it? Whereas I'm getting 6% more. And I trust Mukesh Ambani to run the company well. You mean to say, I know better than Mukesh Ambani or Dhirubhai Ambani. If I know, then I should form Reliance myself. I can't. I'm enjoying the benefit of their intelligence by investing in that company and making money along with them. So, no need for voting right. This is a very drastic comment because, see, many small shareholders will keep jumping up and down. I was the secretary of the Tamil Nadu Investor Association. All these small shareholders and these investors, they'll come and shout, who like that. And ask him, hey, come on, all of you put together, if you go and vote, even then you are not going to cross more than 10% bus. And what difference you're going to make there? So, if Mr. Srikanth, something should be done about it. Nothing can be done. Go home, invest in good companies, invest in good promoters, choose the promoter carefully. If you invest in a Dubakur company, then definitely you lose your money. Because you're getting some additional rights and all, nothing will happen because the Companies Act is designed to support the majority. So better you study the company's performance and then invest rather than rely on this type of rights. Because if you invest in a fraudulent company, all the rights are of no use because the directors would have siphoned the funds. By the time the insolvency starts, no money will be there. Even the most intelligent resolution professional or the insolvency professional will find it difficult to solve the problem, or liquidator will find it difficult to solve the problem because assets would have been alienated, transferred. It will be a litigation after litigation because the fellow is a fraud. He knows he's doing a fraud. He would have protected himself with legal support and lawyers, and there will be 100 lawyers protecting him and safeguarding him. So knowingly don't give your money to untrustworthy people. And how do you know if they're untrustworthy? Go to their back record and see what type of companies they're running, what type of businesses they are running, who are they. This investigation, if you don't do, Sorry, these rights cannot help you. Which is why if Mukesh Ambani offers me zero voting right, 5% more dividend, otherwise he will treat you as the same. Thank you, Jay, I'll take it and give it. Because what is your problem? Today with voting rights in Reliance, what am I doing? I got voting rights shares in Reliance. I don't vote. I don't even bother. I get the dividend. The share value keeps going up. Bonus shares are coming. That's all. What more do I want? Think like that. I mean, this is one view. This is one point of view. Now, as I told you, on a poll, voting rate of a shareholder is in proportion to the value of paid up capital, meaning fully paid share, one vote. Partly paid share, proportionately. Okay. So this is how corporate democracy works in proportion of total value and not the usual one man, one vote concept in conventional democracy. Boss, this is justified because higher the stake, greater the risk. Therefore, greater should be the voting rights. Promoters are taking higher risk. His money is more in the business than you. You have invested what, 20,000 bucks in that business? This guy has invested 200 crores in that business. Okay. Both of you agreed, you are all equal, but he is more equal than you. Whether you like it or not, majority will win. Minority will not. Okay. But which means choose your owner correctly. When you're investing in a business, look at the performance of the promoter, look at the performance of the company in the long term, look at the corporate governance, look at the ethical values of the company and invest. That's the point. Which is why, right from the beginning, when Yes Bank, there was a bank called Yes Bank, they came, I never invested. I will not tell you about that. You read about the promoters in the background of the current debacle of Yes Bank, and then it totally lost, then again it's being revived now. Not the current Yes Bank. The earlier avatar of Yes Bank, I said I will not. Fraudulent promoter. Everything was done for money laundering. I will not do it. I will not invest in that share. Like that. Many people are even telling Srikanth, you're supposed to be a good in share market and all that. You're supposed to be a valuation expert. But how come you're not investing in S Bank? See, the prices are going up. So, chalo, if it's going up, enjoy. I am not interested. Because if I lock myself there, one day or the other, he will destroy me. Which is what happened to S Bank. Finally, the price fell. Those who bought at the high price lost. Now they are again reviving. Somebody came and said, now you can buy, no, sir, the new management. I said, tainted is tainted. I won't touch it. I'm not joking. Now I'll tell you, when Satyam was completely, gone, and it was being restructured. At that time, the business of Satyam, the software business of Satyam came up for sale, and bidders were called for it. Obviously, who can bid for it? TCS, Infosys, etc. But Infosys, Mr. Narayanamurthy refused to bid. On the simple reason, he said it's a tainted company. They have got a bad track record. I won't go near them. Whether it was right or wrong is a bigger call. But see the attitude. Already that fellow Ramalingaraju was a fraud. It's a tainted company. But then that was wrong because the business was a good business. And that business alone could be taken over, which is what Mahindra did. Anand Mahindra took it over and made it what we today call Tech Mahindra, which is a very good company, right? Which is why when Tech Mahindra was formed, I bought Tech Mahindra shares because I trusted Anand Mahindra. Okay, because I know he is an honorable man and businesses run by him are doing well. This is how we have to look at businesses, look at the balance sheets, look at the business as a whole. You will be able to get more information. Okay, so of course, the views expressed herein are the views of the faculty and not the views of the Board of Studies. So, only as a professional, I am telling you all this. So, every equity shareholder has a right to vote on every resolution. Preference shareholders have a right to vote only on resolutions which directly affect their rights. For example, when there's a variation of rights, they will get a right to vote. Or winding up, or repayment or reduction of equity or preference share capital, they get the right to vote. Suppose you're going to reduce the equity capital, preference share capital will get a right because equity liability is being reduced now. So the preference share capital holders have a right. But when can the preference shareholders get the right to vote on all resolutions? Only when the dividend on those preference shares remains unpaid for 2 years or more. If you have not paid him dividend for 2 years or more, then He gets to come and attend all meetings and vote on all matters. Okay. Now, we earlier saw that section 47, voting rights of shareholders. Every equity shareholder has to have a right to vote, every resolution, etc., etc. This section, a private company can do whatever it wants. The private company, by its articles, can say section 47 does not apply to me. Meaning, you can have equity shareholders can have different rights of voting. Okay, every equity shareholder having right to vote need not apply to a private company. Okay. But if the private company's articles are silent, then 47 will apply. But if 47, if the private company says 47 does not apply, then 47 won't apply. Whatever they say will apply. Okay. Then after them, whatever they want to say. Right? Provided there should not be any default. Okay. So the private companies can be somewhat innovative in structuring voting rights of their shareholders. See, many private companies do not know this. Maybe once you start incorporating private companies, you should advise the management. For example, there could be a senior guy. You can say for him the voting rate will be more. Like that you can say. Because you can say 47 will not apply. Okay, like that. You can vary the shareholders' rights. Okay. Where the share capital company is divided into different classes of shares, rights attached to a particular class of shares may be varied. For it, I'll simply give a simple example. Preference shareholders are basically non-cumulative. You can make them cumulative. Okay. Or equity shareholders, you cannot convert them to differential voting rights, but you can create other rights which they want to have. The equity shareholders have no other rights. They get the right to vote and they get the right to receive dividend. But preference shareholders, you can vary the rights. Okay. Or differential voting right shares, you can change the rights. Within that differential voting right itself, suppose they had one vote for every 2 shares. Now they can agree to take one vote for every 4 shares and higher rate of dividend. Whatever. Any variation of a particular class of shares may be varied. But equity shareholders, you cannot vary much. Because what is that to vary? Anyway, dividend, he is not going to get it. He'll get it only if you declare. Nothing else is their voting right. One share, one vote. If you want to reduce that, you can't, because then it will be converting into differential voting rights. You cannot do that. Okay. So other than equity shares, you can vary the rights of preference shareholders or differential voting right shareholders. But provided you get the consent in writing of the holders of not less than 3/4 of the issued shares of that class. So instead of calling for a meeting, you send a post mail to all of them saying, sir, we are proposing that right now your differential voting right shares are 1 share for every 2 votes. Now we are suggesting that you go for one vote for every 4 shares. We will increase your dividend. Already we are giving you 5% more. Now we will give you 7%. In case you're okay for this, kindly sign and send. If 3/4 of those guys, 3/4, suppose there are 100 shareholders, then 75 minimum they agree in writing, then go ahead. Or call for a meeting of those shareholders alone. And at that separate meeting, amongst those shareholders, they have to pass a special resolution. That is, the number of votes cast in favor of those holders of those shares who are attending that meeting and voting out of that group, the number of votes cast against, the number of votes cast in favor should be not less than 3 times the number of votes cast against it, if any. Okay, that is called special resolution, right? See, I don't know how many of you later on went and referred to the section, because many of you may be thinking special resolution means 3/4 majority, 2/3 majority. Srikanth is telling some nonsense. What this 3 times and all, yeah, he's telling some nonsense. No, sir. You please go and refer to the section in management and administration. It is there. Okay. Now, of course, for the purpose of varying the shareholders' right, you have to have a provision in the memorandum or articles. In the absence of the provision, the variation should not be prohibited by the terms of issue of the share. The terms of issue should permit a variation or at least not prohibit the variation. Okay. If the proposed variation would affect the rights of another class of shares, then written consent of 3/4 of such other class also should be obtained. Right. See, the minute you go for differential voting rate shares, definitely equity shareholders' rights are also affected. So they will also be consulted. Yes, sir. It is a general meeting of those. It is a general meeting. See, general meeting means members, whether it is preference shareholders or equity shareholders or differential voting rate shareholders. The minute shareholders are meeting or holders of shares are meeting, it is a general meeting. Okay. Sometimes you can also call this as class meeting. See, you can also call it as class meeting. Means all the shareholders are not meeting. Only a class of shareholders are meeting. Therefore, you can call it as class meeting. But even if you call it a class meeting, the rules applicable to general meeting will apply to the class meetings also. Okay. So that is the correct understanding, Ms. Sandhya. In case there are dissenting shareholders, so for example, you passed a special resolution, right? About, let us say that totally there are 100 people. You called for a meeting, 50 came. Out of that 50, say 10 did not agree, remaining 40 agreed, or holders of 40% agreed. Those attending, they agreed. So you passed a special resolution, you went away. In spite of that, another 50 group is there now who have not come. Out of that, some people are dissenting. They don't want. Not less than 10% of the issued shares of a class who did not consent or did not vote in favor of the special resolution, they can apply to the tribunal to have the variation cancelled. Thereafter, the tribunal will go through it and decide. And the variation shall not take effect unless and until confirmed by the tribunal. Okay. Whatever order given by the tribunal is binding on the shareholders, no more appeal, etc. Calls are to be made on uniform basis on all shares in that class. You cannot say only these shares will make a call, that share we won't make a call. If you're making a call, everybody should have to pay for it. Some people, they may pay calls in advance. Meaning what? See, one more thing I'll tell you. In accountancy paper, you'd have worked out many problems. For example, on where you would have said shareholder, partly a company issued shares, 2 rupees on application, 3 rupees on allotment and all. In reality, almost all companies issue only fully paid shares. At the time of application, the entire amount is received. Rarely you will see partly paid shares. Rarely. One recent example was in 2020 when Reliance came out with partly paid shares. Those are the only partly paid shares as of today in listed companies. Now, suppose you are a shareholder of Reliance. So you are offered those shares, right shares. Those right shares are partly paid shares. So they took only 325 rupees from you. Whereas the total price was 1,500 or 1,275 or something, whatever it is. Now, you are thinking, what nonsense. I will not be bothered about all these things. Mr. Mukesh Ambani, take my money. I'm entitled to get 50 shares. On these 50 shares, the entire amount I'll pay to you, boss. Whenever you make the call, you adjust it. So this is called calls in advance. So a company may, if so authorized by its articles, it can accept from any member the whole or a part of the amount remaining unpaid on any shares held by him, even though it has not been called up. So you can pay. And if the articles are permitting, they can keep it. That will be kept in as liability. It's a liability account, bank account, debtor to calls in advance account. It will be shown under the share capital and under the head share capital. It will be shown calls in advance. Pending allot. Whenever the calls are pending call, whenever the calls are made, it will be taken. Okay. But because we said voting is proportionate, you cannot say, you all guys paid only 1/4, 1/3. I have paid full. I will get full vote on the share. No. Everybody has only 1/3 vote. So there are shareholders who are holding full voting rate share, fully paid share. They will get one full vote. Whereas these partly paid up guys will get only 1/3 vote. Because only 1/3 is paid up now. Boss, I have paid the entire price, 10 rupees I have paid. You have paid only 1/3. So you'll get only 1/3 of the, or I think 1/4. You paid only 1/4. So you'll get only 1/4. So when you vote on your share, if you have 20 shares, it will be only 5 votes. Whereas when I vote on 20 shares, it will be 20 votes. So, but now this calls in advance wala cannot say, hey, I paid the entire amount. No, so I'll get one full vote. No. So amount called up only can be considered. Okay. See, voting rights, if you go, you will see it again. In proportion to the amount, voting right, the voting right will be in proportion to the value paid up. So what is the value paid up? On that amount only you can get. Right. Because you paid calls in advance, it cannot be treated as paid up capital. When it will become paid up capital? Only when I have credited share capital. Here I have not credited share capital. I only credited calls in advance, which is the liability. Later on, when the call is made, I will debit first call account, credit share capital, then reverse first call, bank account debtor, calls in advance account debtor to first call account. That way closing that. Only at that point in time, when I credit share capital, you will get your right. Till then, no voting rights in respect of calls in advance. Was very, very important. Please try to remember this. Class 13 of table F. In table F is the format of the articles of association of a company limited by shares, liabilities limited by shares. So there in the class 13 of table F, the board has power to give some interest on the calls in advance. So clause 13 of table F empowers the board to receive any advance against the calls. They are entitled to receive calls in advance. If they so receive calls in advance, if clause 13 is adopted, then the board is authorized to pay interest, not dividend, interest. On calls in advance, you will not get dividend, only interest. The interest maximum you can pay only 12%. Okay. Or less, but not more. Okay. So can I pay interest on calls advance? Yes, provided there is a provision in the articles or I have adopted table F, clause 13 will apply. How much interest? Maximum 12% can be paid. Okay. Similarly, I made a call, they did not pay. That is called calls in arrears. It is an asset which should ideally come under my current assets, or because it's already due now. It is on payable, already paid and overdue. So it will come only in current asset, ideally. But instead, what I will do, it will show paid up capital, less calls in arrears, net. So the calls in arrears will be reduced here. On that calls in arrears, which is due to you, the board can charge 10% per annum on that calls in arrears. Clause 10 of, same clause 10 of table F, it empowers you to do that. Okay. Company may, if so authorized, pay dividend in proportion to the amount paid up. So, as I told you, no, Reliance will pay on the partly paid shares to the extent of the amount paid up, they will pay dividend for partly paid shares. Okay, so these are some of the points that you might want to remember. I'm sure you are familiar with the issue of shares at a premium. I already mentioned to you, 10 rupees share is the face value. Friends, note it, dividend is paid on that face value. So 10 rupees is the face value. If I'm declaring 2 rupees per share, if I'm declaring 20%, then 10 rupees you pay 20%, which is 2 rupees. Not on the market value or the price at which you bought. That is nobody's number. So as dividend is concerned, it is the face value that we will look at. Right. Suppose I'm issuing shares to the public. My face value is 10 rupees. Company has been running for 10 years. Huge accumulated dividend is there, accumulated reserves. And potential of the company to earn. Valuation is done. And the valuation comes to 350 rupees per share. So one share of this company is worth 350 rupees intrinsic value there. If you go for relative valuation, PE multiple, 600 rupees per share Because similar companies which in this industry are getting a PE multiple of say 15 for an EP. So your EPS is X. If you multiply it by 15, you get 600 rupees. 600 rupees per share. Now, out of that 600, 10 rupees is the face value. 590 is the premium. The extra amount over and above the face value, whatever you get, is called premium. And it is called securities premium. And as you are well aware, it should be credited to a separate account called securities premium account. Now, friends, securities premium account can be used only for the following 5. If you are a listed company, only 3. Okay. What are those matters for which you can use the security premium account? 1, you can issue unissued shares as fully paid up bonus shares. So, securities premium account can be used for issuing fully paid up bonus shares. You can write off the preliminary expenses. If you are an unlisted company, less than 500 crores, you can write off the preliminary expenses. But if you're above 500 crores or listed company, no, this you can't do. In writing off the expenses of or the commission paid or a discount allowed, if you are listed company or above 500 crore, you cannot. Any other company can. Providing for premium payable on redemption of any redeemable preference shares. All companies can do this. If you are a listed company also, you can use it for adjusting premium payable on the redemption of any redeemable preference shares. For purchase of its own shares or other securities, that is for buyback. So securities premium account can be used for buyback. If you want to buy back your own shares, you can use the securities premium account. So this is premium. Only for these 5 matters, you can use it. You cannot use premium for any other purpose. You cannot declare dividend out of security premium account. Nothing else. And that too, if you are an listed company, then B, C not there. Only A, D, and D are available to you. Only A, D, E purpose is available to you. Okay. Why, Mr. Anup, don't ask me. Only one person, God also doesn't know. Only MCA knows why. Okay. They've given one circular. Based on that, it is like the rules are there. Based on that, they have done this. Okay. And I'm not able to understand. Anup, you have put no, sir. For what? No, sir. See, when you put like this, no, how can I? Similarly, Adira wanted to tell once more. I hope what was that once more she has not put in the query pad at all. Okay. Unless you tell me what you want to tell once more, how I will know what to tell. See, this is not a spontaneous class where, I am continuously looking at the query pad. By the time I look at the query in the query pad, I might have crossed many points. So my suggestion, whenever, okay, you won't ask. No, you can, even if you ask me, how can I prevent you, Mr. Anup, from asking a question? But I don't know the answer. You have to go and ask the Ministry of Corporate Affairs only. They also not know the answer. Okay. Now, you please do ask other questions on why. There are many questions where I can give you the why answer. But why this is there like this? G, not even G. G also doesn't know. Okay, God also doesn't know. The Ministry of Corporate Affairs is superior to God. Okay, when a share is issued at a price below the nominal value, it is issued at a discount. Now, company shall not issue shares at a discount. Why? Think about it. You are a creditor. You are giving me 100 rupees. I am crediting 100 rupees only. Whereas I am issuing shares at a discount. He is an equity shareholder. You concentrate, you will understand. When you are a creditor, I take 100 rupees from you. In the books, I credit only 100 rupees. Now I am issuing shares at a discount. He is giving me 90 rupees. I am crediting 100. I am issuing shares at 10 rupees discount. He is giving me only 90 rupees. But how much I am crediting in my books? 100. Now tell me, if you are a creditor, will you accept it? You will say, what, man? I give 100. You are noting it as 100 only. That fellow is giving only 90. You are putting it as 100, yeah. So no. So issue of shares at a discount may affect the creditors because at the time of liquidation, what will happen? Assets will be sold, right? The creditor will get 100, whereas this fellow will get, who paid only 90, will also get 100. So no, okay, that's not good, not allowed. So there's a general prohibition. Here I can answer your question as to why. Okay, the general thing, because if at all shares are allotted at a discount, then it will amount to prejudicing the interest of the creditors. Therefore, they are not permitted, right? But rare exceptions are there. Issue of shares at a discount is allowed under two circumstances. One, when you are issuing sweat equity shares to directors or to employees, you can issue it at a discount. Okay? At a discount. See, again, one more thing. Please note, discount does not mean below the market price. There is not discount. There is only below fair market value. Below the face value. Below nominal value. See, nominal value, face value, one and the same. Face value, nominal value, same. Okay? Now, sometimes what happens, creditors, especially banks and financial institutions, may agree to forego some of their interest and all that. This is given a very nice name. It is called haircut. Okay? They also, the bank also very proudly says, we have taken a haircut like that. Shame on them. They lent money, they could not collect it. Then they go to the creditor, the borrower, fall at his feet and allow him to pay a lesser amount and proudly say, Indian Overseas Bank took a haircut. State Bank of India took a haircut. What haircut? You got cheated by that fellow. That's what it means finally. Whatever it is, because their logic is very simple, sir. They're saying, okay, Mr. Srikanth, you're telling I should fight. If I go to court, what will happen? The whole matter will get delayed 20 years. That cost I'm saving, boss. I'm giving it to this bugger. It's straight away I go for a settlement and I give it to him. Right? So see, this argument has both sides. One is, of course, the citizen of the country, and thereby the one of the out of my tax money only you got that loan, you gave that loan. Now you are giving a haircut. Taking a haircut means I'm taking a haircut along with you. Am I correct or not? So that is one indignant way of looking at it as a citizen of the country. Another is as a practical chartered accountant, finance-wise. After all, if I enforce my, of course, originally I gave the loan foolishly to a man who is not capable of returning to I trusted the fellow. He had no business knowledge, but I gave the money to him. He lost it. He became insolvent. Assets are not sufficient to pay, or maybe huge assets are there, but by the time they are sold and recovered, it will be too late. Some revival scheme is coming. Somebody is coming in to take over the company and run it. Now, when that guy comes, he says, come on, I can't take the old debt. Now we are doing a debt restructuring for him. And in the debt restructuring, we are saying, look here, you owe us interest so much. We'll charge simple interest. Forget the compound interest. Pay us something. Principal, take it. Now, you pay for some portion in the balance portion, I will take shares. My loan can be converted into shares. While converting the loan or debt into shares, they will say, hey, I have given you some concession on interest now. No, you do one thing. When you are taking over this loan and converting it into shares, do it at a discount. So normal share is worth 10 rupees. You give me a discount, 8 rupees per share, so that the number of shares I will get will be more. And later on, when you want to buy back or in the time of winding up, I'll get something. So minimum. This is in order to compensate them for the interest that they are foregoing. That is the logic of this provision. This is the only situation where a company can issue shares at a discount. The only other situation, only two are there. The other situation is when they are issuing sweat equity shares to a director, they can issue it at a discount. These are the only two exceptions. Okay. In case the company issues shares at a discount, it has to be refunded. Other than these two exceptions, if you issue it, that allotment is void. If you issue shares at a discount, any share issued by the company at a discount price shall be void, which means the entire amount should be refunded. with interest at 12% per annum to the applicants. Okay, because see, boss, you are all highly intelligent and you know company law. Ma. There may be a lot of people like me who don't know company law. When we see, we will apply and we will pay the money also. Even then, the allotment itself is void, and the money has to be refunded to me at 12%. Okay, so here we have a type of question. Let us see if you can answer it. S Limited issued 2010% preference shares rupees 100 each, which are redeemable at a premium of 10%. Okay, for the purpose of redemption, the company, okay, this is getting into redemption of preference shares. One second, let me see. Yeah, so redemption of preference shares, then why I have not, yeah, second. Let's see if I have it somewhere, then I'll come back here. See, basically, preference shares are to be redeemed. In India, you cannot issue preference shares which are irredeemable. You cannot issue preference shares which are irredeemable. If you're going to issue shares, preference shares, they should be redeemed within 20 years. In case you are an infrastructure company, you can extend the period by another 10 years because infrastructure companies have a longer gestation period. They take longer time to make money. Therefore, infrastructure companies alone, as are mentioned in the 7th schedule, only those companies can go for longer redemption period of 30 years. Even such companies should start redeeming 10% of the value from the beginning of the 21st year, so that by the 30th year, the complete amount should be redeemed. Okay, so the idea is you should redeem it. Irredeemable preference shares cannot be issued. Irredeemable means no. 20 years redemption or maximum 30 for infrastructure companies. Got it? Now, how can I redeem preference shares? Either out of profits or out of proceeds of a fresh issue. Either out of profits or out of proceeds of a fresh issue. So, what is a profit? Only free reserves can be taken for this purpose. What is a free reserve? A reserve which is available for declaring dividend is called free reserve. A reserve which is available for declaring dividend is called free reserve. It does not include revaluation reserve. It does not include capital reserves which are not available for declaring dividend. For example, forfeiture of shares. At the end of it, if any profit is there on reissue, that has to be transferred to capital reserve. Now, that is a capital profit, not to be used for declaring dividend. It should be in the balance sheet. Okay, like that. So, one exception is there. Suppose you sell a building or sell a fixed asset and you are making some money out of that profit. That profit which is realized in cash or realized in money, you can use it for declaring dividend. So that can be considered as free reserve. To the extent that it's a profit on sale of asset which is realized in money. To that extent, even a capital profit can be taken as a free reserve. But otherwise, no. Suppose you're applying Ind AS and you're valuing it at fair market value. For that purpose, you're creating one notional reserve. Sorry, those reserves are not available for declaring dividend. Okay, so free reserve means any reserve which is available for declaring dividend. So you can redeem preference shares out of free reserves, profits available for declaring dividend, or out of proceeds of a fresh issue. Whichever. Suppose profits are not sufficient, you go for a fresh issue. Nominal value of the shares can be considered. Only the value of the premium cannot be considered. Why? Because premium can be used only for those three purposes. You cannot use it for redeeming preference shares. If at all any premium is there on the redemption of preference share, that premium can be adjusted against this security premium. That's all. The preference share nominal value cannot be considered for out of security premium. Right. Points to be noted and to be remembered. Here, based on that, let us look at this. S Limited issued 2010% preference shares of 100 each at par, which are redeemable at a premium of 10%. Means at the time of redemption, every share I will redeem 110 rupees. 2000 into 110, 10 rupees premium. When I pay him back, I pay 100 rupees plus 10 rupees. For the purpose of redemption, the company issued 1,500 equity shares of 100 each at a premium of 20%, which means 1,500 equity shares are issued, face value 100, 20 rupees premium. At the time of redemption of preference shares, what is the amount to be transferred? Yes. See, when you are redeeming preference shares out of profits, when preference shares are redeemed out of profits, a sum equal to the nominal value of the preference shares redeemed out of profit should be transferred to the CRR, Capital Redemption Reserve. When you are redeeming preference shares out of profit, a sum equal to the nominal value of the preference shares redeemed out of profits should be transferred to Capital Redemption Reserve. Okay, so what is the amount to be transferred to Capital Redemption Reserve? The amount which is redeemed out of profit, the nominal value. How do I find that out? How much is covered by the equity share issue we see? Balance is out of profit now. See, totally I have to redeem 2,000 into 100, 2 lakhs. 10 rupees premium, don't consider. That is the cost you are incurring. If at all from the security premium, you can adjust it. But only the nominal value you have to take. What is the nominal value? 2,000. Out of that, you are issuing fresh equity shares. How much? 1,500 into 100, 1,50,000. So balance 50,000, not covered by the proceeds of the fresh issue, should have been out of profits. So that amount would have come out of P&L account. So that amount should be transferred to the Capital Redemption Reserve account. I'll repeat, whenever you are redeeming preference shares out of profits, and the nominal value of the preference shares redeemed out of profits should be transferred. So here, out of 2,000 preference shares of 100 each, 1,500 are being adjusted against the equity. New equity shares are 100 rupees. Balance 500 shares at 100 rupees, 5,000. Okay, I'm sorry, 50,000 not covered by fresh issue. To that extent, I have to use the P&L account, assuming that there is a balance in the P&L account. Assume that profits are sufficient. To the extent I am using the profits, I have to transfer this amount to the Capital Redemption Reserve account. Now, Capital Redemption Reserve account cannot be used for declaring dividend. It will be locked up. Once you transfer it to CRR, it will become permanent capital of the company. Idea is simple, ma. You took preference shares. Okay. To the extent that you are redeeming, they are saying, lock it. Don't declare dividend out of that. Thereafter, this amount cannot be used for declaring dividend. It will become part of the permanent capital. Okay, you don't want to do that? Then get fresh issue. Let it become part of the permanent capital. Out of that, you redeem either out of profits or out of the issue of a fresh issue of equity shares, whichever you want, you can use. Okay. I'm sure this you have already studied it in financial reporting also. I don't know. Or maybe, I don't know about that. I'm sure it's basically accounting also, it will come. See, these are the overlaps between company law and company accounts. Okay, Ajay Limited decided to redeem 10,000 preference shares of rupees 10 each at 10% premium. Balance in P&L account 60,000. Securities premium account 10,000. Now, how much is the minimum number of equity shares to be issued? Right. So P&L account has a balance of 60. How much do I need? 10,000 preference shares into 10 rupees nominal value, 1 lakh. Out of that 1 lakh, I can adjust that 60,000 in P&L account, which means balance is only 40,000. This 40,000, I need to issue equity shares. Okay, at a premium of 20%, that doesn't matter. I have to take only the nominal value. So 40,000 divided by 10, I have to issue 4,000 fresh equity shares, on which I'll collect 40,000 nominal value, which will be adjusted. So entire 1 lakh is covered. 60,000 out of profit, 40,000 out of fresh issue at 4,000 shares of rupees 10 each. Of course, at a premium of 20%. Now the premium I collect, 4,000 into 10. Okay. 40,000 plus 20% of 40,000 is 8,000 rupees. You will collect 8,000 rupees premium on these shares. That security premium, along with that already existing security premium, that can be used. Total 18,000. That can be used for adjusting the premium on redemption. 10,000 into 10%, 1 lakh, 10,000 rupees. You can adjust. So this security premium 10,000 can be adjusted for that premium on redemption of the preference shares and close it. Security premium account can be used for adjusting premium on prepaid on redemption. Right. So this is I think. Then of course you have the yeah, 3B. Yeah. How do you get 3B? Oh, 3B. 3A. Pooja Gupta gets 3B. I remember Pooja Gupta used to attend some of my earlier sessions. I hope it is the same Pooja Gupta. I don't know. Okay, no problem. Chal. Moving on. So rights issue or the preemptive right of equity shareholders. See, basically, rights issue is meant to protect the minority. What happens? Suppose there is a company in which there are 1 lakh shares. 1 lakh shares. Majority is holding 90,000, minority is holding 10,000. Now the company wants to go for a fresh issue. Now the majority, what they do, the entire fresh issue, they allot to themselves. Now what will happen? Earlier the minority was 10%. 10,000 by 1 lakh. Now they are 5%. So out of 2 lakhs, now they become 10,000. So now they become 5%. So slowly, by issuing fresh shares and allotting it to themselves, the majority can grow and the minority will be reduced to minuscule minority. They will dilute the minority. To prevent this, the law says, whenever a company goes for a fresh equity issue, the existing shareholders should be offered these shares in the same proportion as they are currently holding. So my guru always used to ask me, Professor K. Sanataraman, in the class, he'll say, when a photograph is enlarged, which part will be enlarged more? Some student will answer, sir, head will be enlarged more. No. When the enlarging happens, it will enlarge proportionately. Now, same way, when the capital is growing, it should grow proportionately. Minority. So when I'm issuing fresh 1 lakh, I should offer the minority 10,000 shares. I will take 90. So that on 2 lakhs, they will hold 20, I will hold 180. Still the percentage will be 10%, 90%. So the percentage should not be diluted. Okay. One more thing. I am the minority shareholder. You are offering the 10,000 shares to me. I don't have money. What can I do? I can pass it on to somebody else. There is a right to assign or transfer the right to someone else. This is called right of renunciation. To renounce means to give up. The offeree is renouncing his right to subscribe. For example, when I received an offer for right shares in Reliance, at that time, the number crunching was such that it was actually favorable for me to sell the right itself. The right itself was being sold at 300 or 350 or 370 rupees. If I sell the right and I buy the share in the open market, the price was such that I got a lower price than the rights offer. For a very short window, it was there. Immediately, I sold the right, which means what? I renounced the right. Some other person got it. He would have bought those 16 shares. Instead, I got 376 into 16 rupees in my account, in my credit. Plus, I purchased the share at the current market price, which means out of the current market price, this amount will be reduced now. 376 will reduce. My price was lower than the rights offer itself. I made money that way. And it was better for me to do this, financially better for me. Later on, what happened? The price started going. Then the opportunity went off. The opportunity window was there for 2 days. Quickly, we did it and I came out. Whatever it is. Then, of course, I did one foolish thing. What I should have done, I should have kept quiet, not sold that share. Instead, when it went to 1,700, 1,800, Reliance went to 1,800, I sold it. If I had kept it today, it's 2,137 rupees. It's okay. At that time, I sold it and I booked the profit. Okay, whatever it is. Now, all I'm trying to tell you is right shares can be renounced. Okay. Now, sorry, I don't know why this came here. Sorry, I think I skipped it. Sorry. Yeah. So, what happens if a company wants to allot shares to others? Suppose I don't want to go for rights issue. So, the section 62 says, whenever a company proposes to increase its subscribed capital by issue of further shares, such further shares shall be offered to the existing equity shareholders as nearly as circumstances admit in proportion to the paid up share capital on those shares. The offer should be made by a notice and should remain open for 15 days or such lesser number of days. Currently, it is 7 days. Was the central government has prescribed 7 days now. It can be lesser, as may be prescribed, less than 15. They have prescribed 7 days. The minimum period, they have now made it 7 days. Maximum is 30 days. Minimum in the act is 15. Central government has now prescribed 7 days. Rule 12A, which came into effect from 1/4/21. So if you have an older version of the book and if you're seeing something else, please correct it to 7 days. Okay. Now, where 90% of the members of a private company consent in writing, the offer may remain open for lesser period than stated up. Okay, normally 7 days. Reliance rights issue, I remember, was for it was open for 15 days. Sorry. Now, sorry. Unless the articles provide otherwise, the offer shall be deemed to include a right of renunciation. Now, instead of doing this, you can also make an offer. The rights shares can be offered to the existing shareholders. Existing shareholders on ESOP basis, you can give. Or you can allot these shares to, if you're going to allot these shares on the basis of a condition in the debentures and loans, at the time of issue of the debenture or loan, the terms of the issue of debenture or loan says, in case the company does not pay, they can convert the loan into a shares. Then 62 will not apply. Okay. So, or if the company passes a special resolution, straight away you can allot these shares to anybody you want. Anybody you want. But for that, the existing equity shareholders should pass a special resolution. Right. Similarly, when government has the right to convert and they do that, then this section will not apply. Right. Now, quickly, I want to take you through reduction of capital. Let's look at questions. Is there any time duration to claim the right share? Yeah, see this what? They can keep it open for 15 days. Within that 15 days, you have to apply and you have to get it. If you don't, see what happens now, they will, Ms. Ruhani Jain, you will be having a DP account, I'm sure, depository participant account. In that account, a registered email will be there. You would have registered on email. That email is where the message will come. The email will come to that email ID. The company will send a proper offer. In that rights offer, they will clearly mention what is the thing. Okay. Vedant Chaturvedi about Hindi, already comments have been given by me. No Hindi, only English. If you can understand English, please continue to listen. Okay, Mr. Chaturvedi, got it? I think every class I cannot keep telling you no Hindi, no Hindi, no Hindi. Okay? These classes are meant to be conducted in English. Examination is meant to be written in English. If you are writing in Hindi, sorry, I cannot teach in Hindi. Please don't come to me. I'm not expected to teach in Hindi also. Okay, please don't do this every class. Yeah, getting bugged. You people also should understand somewhere. Hindi, if you can't understand English, what can I do, Baba? I can't do anything about it. Okay, please, I'm getting a little bug. Okay, don't expect it as a matter of right. I don't know Hindi, Mr. Chaturvedi. your brain around this concept. There are people in this country who cannot speak Hindi like me. Okay, but I can speak English and I know the subject. You want to listen, listen. Sorry. Please. This is the end of this talk. No more comment here. If I can sum up in Hindi, why I will not speak in Hindi, Baba? I don't know Hindi. You understand? See, try to learn English, ma. Okay. Try to learn. Thoda. Sikhian, so that you will learn fast. Please. Somewhere you will need English in your life, yeah. One day, see, faculty can help you by speaking in Hindi, no? We are actually spoiling your life. Those faculty who are speaking to you in Hindi, spoiling your life. Because you will never learn English. They speak to you in Hindi, you will never learn English. Think about it. It's in your own interest, I'm telling Mr. Chaturvedi. A day will come when you will understand what Srikanth is telling is correct. I wish I had learned English there at that time. Oh, I feel so bad. Other people are getting opportunity, which I'm missing, sir, because I don't know English. Fluently, I'm not able to speak English. That feeling will come to you. Not now. At a time, it will come. Then you will remember what Srikanth told. And you will wish, hey, at that time that fellow told, at that time I irritated him and insulted him and said, if you can't speak Hindi, you are not an Indian and all. Agreed, I'm not an Indian, Baba. I'm a Persian. Huh? Oh, enjoy. Okay, I'm an Aryan. Boss, I will speak in Tamil. Will you try to understand in Tamil? I can explain very beautifully in Tamil. Shall I do it? Don't waste your time and other people's time. Listen in English. That's it. No other option. If you have any problem, you complain. Go. There's a limit to how much I can put up. Every time somebody is saying Hindi. I've been telling 100 times I can't speak Hindi. How many times I should tell I can't speak Hindi? You don't stretch it, sir, please. There's a limit to how much a faculty like me, senior faculty, can take. You also don't stretch it. Okay. It's you who put that comment about, I know English well and all. Okay. If you know English well, then listen to me in English. Okay. Okay, good. Going on with the topic. Sometimes I get irritated. Not always. Sometimes I get irritated. Don't take it otherwise. My intention is not to hurt, but to help you understand. Topic is being taught. Take it in the right spirit. Okay. Now, moving on. Because, moreover, this class also is not elaborate class. It is meant to be taught fast. So, I cannot teach everything. I have to go a little fast. Reduction of capital. As I told you, a company's capital is the representation of what the creditors can get. So the share capital and free reserves which are there in the balance sheet should be represented by assets. If the capital is not represented by assets, then it is better that you reduce the capital, meaning you reverse the share capital. This is one more situation where share capital account will be debited. It's called capital restructuring. See, if you look at the balance sheet of such a company, you will understand. The balance sheet will be like this. You will have share capital, no free reserves, you will have accumulated losses. Against that, there will be fixed assets. Okay, against that, there will be fixed assets. But those fixed assets will not be worth much. Some current assets will be there. For that, current liabilities will be there. Almost insolvent company. Almost insolvent. Bank loan also will be there. Okay, so what this company needs to do? They will first of all revalue the assets to show them at the current market value. Also, they will know that to that extent, the capital is not there. So they will go to the lenders and they will say, please come for a haircut. The lender will say, okay, Baba, I'll come for a haircut. What are you going to do? So, no, what do you want us to do? Your 100 rupees is not represented by asset, Baba. Make it 1 rupee or make it 10 paisa. You reduce your share capital, which is not represented by assets. This is one argument. Another argument is where company's balance sheet is one of plenty, balance sheet of plenty, assets are there. Means they sold an asset at a huge capital gain. Therefore, they are having huge capital reserve. they are having capital in excess of want, overcapitalization. In those cases, what they can do, they can return some of the capital back to the shareholders by reducing the capital. Means what they can say, boss, you gave us 10 rupees. Now we have more than what we need. We'll give back 9 rupees or 9 rupees 90 paisa. Take it. And we'll keep only 10 rupees only for the purpose of giving you dividend, etc. We'll keep it. This is another example. In fact, this example was where there was a company called None Such Tea Estate, which had sold its estates, and it resulted in huge capital gain. That company returned its capital, which was in excess of want. Again, you have to reduce the capital, which means what? I pay back 9 rupees 90 paisa and I bring the capital to 10 paisa. But money is there in that company. It's a solvent company. Later on, for declaring dividend, etc., the 10 paisa will be used. Okay. So both the cases are there. In both cases, you have to go for reduction. For that, you have to first extinguishing the liability on those shares. Okay. And one important point is, if you want to do it, two procedures are there. One is you have to pass a special resolution. The next is you have to get confirmation by tribunal. Why tribunal confirmation? Because, see, this is a serious case where they are going to write off the capital. Before doing that, the tribunal will give notice to all the interested parties. Central government, means the income tax department, the GST, the registrar of companies, SEBI, creditors, everybody will be given a notice and will be asked to give NOC. And all the creditors should give an NOC. Only if any creditor who's saying, no, how can it be written off? No. He'll have an objection. So once everybody has confirmed it, then they can go for reduction of capital. Okay. Before taking it up, the notice will be given by tribunal to all the stakeholders. They'll be given time to make representations within 3 months. And if no representation is received, then there is a presumption as to no objection. In case any representations are received, they will be considered. And finally, the tribunal will pass an order for reduction. In case of any creditor, the creditor should either give an NOC or he should be fully discharged, or at least the amount should be determined and he should be given some security for it. The company should tell him, Baba, I agree with you, you are affected now. For you alone, you will create a security of this asset. So even if there is anything problem, you will get your money. Don't worry. Something like that. Okay. Finally, they will confirm the reduction of capital upon such conditions as it deems fit. Okay. So now, tribunal not to sanction any application of reduction of capital unless the accounting treatment proposed by the company for such reduction is in conformity with the accounting standards. Okay. And the entry should be made. Okay. Then this order should be published by the company so that everybody will be aware that the reduction has happened and should be delivered to the registrar for registration within 30 days. Okay. Note will be made. The whole idea is to make it into a public knowledge so that in future, if anybody wants to have dealing with the company, they will know that this company has gone for reduction of capital. Okay. Now, in case any creditor, due to some unintentional purpose or something, he was left out. Now, please note, this will be relevant only for partly paid shares because there is no further liability on fully paid shares. Keep this in mind while understanding this provision. If you are a fully paid shareholder, you have no problem. Simply go. But if you are a partly paid shares, then there is a liability on those shares. In those cases, in case a creditor was left out, see, a creditor who is entitled to object was not entered in the list of creditors. Because he was ignorant of the proceedings, he didn't claim whatever reason. After the reduction, if the company pays him, no problem. If the company defaults in settling his claim, then that To that extent, those shareholders who are there, partly paid shareholders, on the day of reduction, they would be entitled, they alone have become liable to pay to this guy. Because to that extent, their liability was reduced now. So that liability will be again created. And they have to contribute and pay to this guy whose name was left out of the list of creditors. Right? Similarly, company cannot purchase its own shares unless the consequent reduction in capital is effected. Now, the point you have to understand is company cannot purchase its own shares unless the consequent reduction is accepted. The only exception to this is buyback. See, buyback is one method by which a company can purchase its own shares in a systematic manner. Under buyback of securities, a company can purchase its own shares in a systematic manner. Okay? That is, it can go through the process which is mentioned in section 68 and the rules made for this purpose. If you are a listed company, then you have to comply with the requirements of the SEBI guidelines. But basic structure is very simple. Every year, every financial year, if you pass a special resolution, by passing a special resolution, a company can buy back 25% or less of its paid up capital and free reserves. In case you don't want to pass a special resolution, you just want to pass a board resolution. It's easier now. Instead of calling for a board general meeting and all, you want to go for a board resolution. Then 10% or less of the paid up capital and free reserve only by passing a board resolution. Only by passing a board resolution, 10%. You see, this board resolution provision is given because, see, if you apply your mind, you will understand. If you are a CFO of a company, a finance professional, when you will advise the company to go for a buyback. Of course, some people will say when there is a takeover, adverse takeover and all that. The real financially viable reason, logical reason why you will go for a buyback is when the market price of the share, please listen to me, the market price of the share is less than its intrinsic value. See, the company has an intrinsic value there. Means based on the future earning capacity of the company, if you use a discounted cash flow technique, you will come out with what is known as intrinsic value. Or forget all that. You take only the real estate. You take only the fixed assets of the company. You go for a fair market value of those fixed assets. Divide it by the number of shares. You will get what is known as net asset value. Sometimes what happens when market is in a very bearish condition, when market is collapsed due to some other external economic factors, some healthy companies' shares will be quoting in the market well below their book value or well below their, shall we say, intrinsic value. Intrinsic value is a little difficult to understand. For example, Maruti Udyog Limited, Maruti Suzuki was quoting at 900 rupees. 900 rupees in 2009. Because of bad market sentiment, rightly or wrongly, anybody who did a value, forget me, anybody who did a proper valuation for intrinsic valuation method would have got minimum 1,200 to 1,300. Worst case scenario. Worst case scenario. Maruti Udyog loses market share. Maruti Udyog is unable to, even with all the reduced market share, if you project it for the next 20 years, you will still get 1,200 to 1,500 rupees value per share. Okay. So anybody would have intelligent would have purchased that share, including Maruti Suzuki itself should have purchased its own shares at that time. Now, such a window of opportunity will come only very few times. What happens is, if you are a smart financial manager, what you will do, you will purchase your own share. When you do that, what will happen? The liability to that extent will come down now. Only the remaining equity shareholders will be there. Only at the time of winding up, I have to pay only those people. And I would have purchased these shares at a profit because later on, the company is worth much more. And that wealth will be shared only by the remaining people. So buyback makes sense. Many times they do that. Wipro came out of the buyback recently. And of course, one more reason why they go for the buyback is because today dividend is charged to tax. So instead of giving dividend, we make a minor buyback so that the guy gives his shares. To that extent, he gets the money now. That profit will compensate him for the dividend. And tax-wise, that is less tax, 10% tax now on sale. Whereas here it is, if your tax bracket is even 40%, 30% tax. Therefore, for tax planning also it happens. Every year, if you notice, around June, July, TCS will come out with a buyback. Religiously, they'll come out with a buyback. Small amount they'll buy back, give whatever, and they will offer a price which is higher than the market price, and they will take it from you. Okay, the idea is it's more of a tax planning thing, right? Anyway, so whatever it is, buyback is possible up to 25% of the paid up capital. But when you're going for 25% through special resolution, remember, you cannot buy back more than 25% of the total paid up equity capital. So they said in respect of buyback of equity shares in financial year, the reference to 25% shall be construed with respect to its total paid up equity capital. A company cannot buy back more than 25% of its paid up equity capital in any financial year. So if you give this example, you'll understand. I can buy back up to 25% of PC plus FR, paid up capital and free reserves. So in this company, the paid up equity capital is 100, the paid up preference capital is 200, free reserves 200. So paid up capital plus free reserves is 500. Paid up capital plus free reserves 500. Okay. So the section says I can buy back only 25% of my total paid up equity capital. What is 25% of my paid up equity capital? 25% of 100. Only 25 crores. But to buy those 25 crore, see 25 crore worth of shares. That means what? 2 crore 50 lakh shares. 25 crore divided by 10 rupees per share. 25 crore, 100 into 25%, 25 crore, only I can buy back face value divided by 10 rupees. 10 rupee face value now. So I can buy back only 2 crore 50 lakh shares. Now, to buy back this 2 crore 50 lakh shares, how much I have to spend? I have to pay the market price now. No shareholder will give me below the market price. Why should he give it to me below the market price? Because he can also sell it in the market, right? So either I have to give him slightly above the market price or market price. So market price of these shares is 50 rupees. So 50 into 2 crore 50 lakhs gives me 125 crores. Now, the amount which I need, amount required for buyback is 2 crore 50 lakh shares into 50 gives me 125 crore rupees I need, which is equal to 25% of your paid up capital and free reserves. In this case, this is exactly tallying. I need 125 crores. I got. Suppose the market price of the share is, for example, 75 rupees. Suppose the market price of the share is 75 rupees. Then what happens? 2 crore 50 lakh shares, 2 crore 50 lakh shares divided by 75 now. I get something like, I can buy back only, see earlier I could buy back, I'm so sorry. 2 crore 50 lakh is what I can buy back. 2 crore 50 lakhs into 75. I need 187 crore 50 lakhs. Now I don't have that type of money. I can buy back only up to 25% of PC plus FR, which is 125, which means what I should do now? Now I have to do in a different way of calculation. I can only spend 125 crore. I have to buy back at 75 lakhs. So 125 crores, 0000000 divided by 75. I get something like 1 crore 66 lakh 66,000 shares. I cannot buy back 2 crore 50. I can buy back only 1 crore 66,666,666. Why? If this price goes to 75. Suppose this price, instead of 50, it becomes 75. Then here, this will become 75. Then this amount will be more. I can't do. I'm restricted to this. Therefore, I have to reduce this, which means I have to go for 1 crore 66,666. Into 75, you will get 125, roughly. So I have to reduce the number of shares. So this calculation needs to be done, right? In addition to this, after the buyback, the debt is to equity ratio in the company cannot go beyond 2:1. The debt is to equity ratio should be maintained at 2:1. Okay. And in some cases, you can go for a higher ratio, but that is only for public sector undertakings. Rarely central government will give specific to one company. They will give for a class of companies, but not to specific to one company. Okay. The shares for the buyback should be fully paid up, and the buyback of shares of listed companies to be as per the SEBI guidelines, and unlisted companies based on Rule 17. And once you make one offer for buyback, you cannot make another offer within 1 year. So 1 year should pass from the closure of the preceding buyback. Okay. So you can use free reserves, securities premium account, and proceeds of the issue of any shares or other specified security. Just like for preference shares, you could go for proceeds of fresh issue. Here also you can do. But the issue of shares should not be for the same time. Means if you are going to buy back equity, you cannot issue further equity shares. You can either issue debentures or you can issue preference shares, right? From whom can the company buy back its securities? From existing shareholders, open market, or in case you are given an ESOP, and as part of the ESOP, you have told the employees, in case the price falls below a limit, we will buy back from you at a given price. You can buy back from them. Okay. Buyback should be completed within 1 year from the date of passing of the special resolution or board resolution. Whatever shares or securities are being bought back should be extinguished and physically destroyed within 7 days. So these are the conditions for the buyback, right? Now, all right. Ruhani Jain is asking a nice question. Once the capital is reduced now, automatically to that extent, the face value will come down. So obviously, to that extent, the dividend will be reduced. Or what you should do, you should proportionately increase the percentage and give it if you want to give. That's right. The question is correct. A company can buy back a maximum of 25% paid up capital once only. After buying back 25% in one financial year, can it opt to buy back again in subsequent year? Yes, see, you make an offer of buyback, the offer gets closed, then you can't issue for another 1 year. You can't make further offer for 1 year, right? You can't make 1 year. After the 1 year, you can again make 25%, which is why every year you can buy back 25%. That's why I said, religiously, the company like TCS will go for buyback every year. In a way, by that method, they will reduce their overall liability. See, in finance management, you will learn one important point. What is that? The goal of financial management, you will see, is increasing the shareholder wealth. This is one extraordinary method by which you can increase the shareholder wealth. Okay, good. Now, okay, see, bouquets and brickbats. On the one hand, I'm getting brickbat from Mr. Chaturvedi. On the other hand, I'm getting bouquet from Mr. Veerababu. Thank you, sir. And he's saying your teaching is awesome, etc. In Tamil, we have, a famous Kaniyan Pungundranar who said, Yadum Ure Yavarum Kelir, Tidum Nandrum Piradara Vara. It's a beautiful poem. He says, everywhere is my native place and every person is my relative. Yavarum Kelir. And he said, good or bad does not come from outside. Good or bad is within. You see? So that is the point. So no. By another person comment, I'm not affected. By another person, good comment also I'm not affected. Bad comment also I'm not affected. I have to keep doing my duty. That is my job. Okay. Anyway, I'm happy, Mr. Veerababu, for giving such nice words. Thank you very much for you. So, moving on. Company not to make further issue of securities of same kind within 6 months. Meaning, you cannot buy back on the one side and within 6 months again issue equity shares. For 6 months, you cannot issue further issue of securities of the same kind. Okay. Exceptions are obviously bonus issue, conversion of preference shares, discharge of subsisting obligations on warrants. Suppose they have issued share warrants and these share warrants are being converted into share capital. Share warrants are bearer. So you have issued share warrant without mentioning the name of the owner. Then these share warrants are presented to you. You have to again issue share certificates. Allowed. With the name of the person you have to issue. Allowed. Similarly, if there are ESOP schemes where the stock option has been given to employees, they want to exchange the option for shares, you can give. All that is allowed. But consciously, you cannot make a further issue. You can say further fresh issue of equity. So these are the procedures to be done. We have seen that. Also, you have to give a declaration of solvency. The idea is a company going for buyback should go for a declaration of solvency in form SH9. Why declaration of solvency? See, an insolvent company should not reduce its equity capital, thereby reducing the liability of the equity shareholders. No. But then, in all fairness, in other words, an insolvent company should not pay back the equity shareholders. So they should say, in case the company goes into winding up in the next 1 year or 2 years, all the liabilities will be fully paid like that. See, remember, if you go through reduction process, then you have to go to tribunal, get NOC from shareholders, all that. Whereas this is an easy route. Just pass a special resolution, give a declaration of solvency, comply with all the requirements, straight away buyback, enjoy. Okay. So they have to confirm that the company will not be rendered insolvent within a period of 1 year from the date of declaration adopted by the board. Right. Similarly, whatever is the nominal value of the shares being bought back should be transferred to capital redemption reserve. And the capital redemption reserve account may be applied by the company in issuing bonus shares. It cannot be used for declaring dividend. But CRR can be used for issuing bonus shares. Similarly, where the company has made default in all this, similar to DVR, do you notice? Repayment of deposit, debenture, dividend, loan and interest to financial institution, etc. Then, in case there is a default, if you remedy the default, even then, the buyback can be made only after the lapse of 3 years. Okay. So, this is there. Now we move on to the next topic. With the debentures, I'll come to an end for this topic. What I will do is, I will open up for questions in the oral mode. Basically, a debenture is a debt instrument. It is a document or instrument evidencing a debt. Okay. By issuing debentures, the company can source debt finance from the public. Okay. See, instead of going to one lender and borrowing, I'm going to float an instrument which will be subscribed by the public. But it will be a debt instrument. So basically, it's a loan on which I have to pay interest, except that I have not one lender, but numerous lenders. One more advantage is when I borrow from the bank cannot sell my loan to anybody else unless they go for securitization process, which is there should be a securitization company. That company should value my debt portfolio, RBI approval. It's a very long-winded process. Whereas here it's very simple, boss. Today I have surplus money. I buy your debenture. I enjoy for 6 months. 1 year I take interest. Thereafter I need money. Immediately I go to the market, sell my debenture, realize my money, go. So when I have short-term liquidity, I can use it to invest in debt. and easily I can sell the debt and walk out. Thereby, debentures are saleable in the market. There is a market for debentures. So being instruments, they can be sold. Like share debenture can also be sold. But debenture is a debt. Therefore, the debenture holders shall not carry any voting rights in the normal shareholders meeting. But if the rights of the debenture holders are affected, then they will have a meeting of debenture holders, which is a class meeting. And in that class meeting, again, the rules of meeting, general meeting will apply to that. And everything will be accordingly done. Okay. In addition to that, whenever a company issues debentures, it has to create debenture redemption reserve account. I'm sure in your accounting subject, you would have studied this. See, DRR is compulsory only for unlisted companies other than NBFCs, housing finance companies, that too when they go for private placement. When you're going for a public issue, no need for DRR. Okay. The idea is simple. Suppose you're a bank or a financial institution or a listed company, okay, which is going for a public issue or private placement, it is expected that you have financial discipline to create your own reserve. Whereas if you're an unlisted company, they are saying compulsorily 10% of the value of outstanding debentures, every year you have to create a DRR. So every year you transfer 10% to the DRR account. So the DRR will keep building. And in case, see, to that extent, that money will be earmarked. Of course, if you are a really good financial manager, what you will do, not only you create debenture redemption reserve, to the extent of that, you will transfer it to the debenture redemption reserve investment and use that money for the purpose of redemption of the debenture. But see, today there's a bigger view. Think about it. Reliance Industries Limited, the return on investment is 24.5%. Whereas if Reliance Industries takes this money and gives it to, say, HDFC Bank, the bank will give only 8% interest. Yeah. Now, if I'm a shareholder of Reliance, I will tell them, boss, don't take your money and put it there. Keep that money in this business only. Just ensure that you have liquidity at the time of repayment of the debenture so that you pay them off. Makes sense. Because the return on investment here is better. Unless you want to mitigate that risk and you want to say, hey, I want to be careful about it. So a portion of it, I'll keep it separately in a lesser risky investment. That's what they're trying to say, which is what they want you to do. Whenever a company is, unlisted company is creating a DRR, debenture redemption reserve, they are saying you also have to transfer some money to a separate deposit account. How much? Not less than 15% of the amount of its debentures maturing during the year ending on the 31st day of March next following. See, now I am sitting in 24-25. On or before 30th April, what I should do, I should see what are all the debentures maturing on or before 31st March 2025. So before 34-24, I should deposit 15% of those debentures which are maturing on or before 31st March in a separate account with a deposit with a scheduled bank or in government security or in bonds. Okay, secured bonds, safe bonds under the Indian Trust Act. Unencumbered means these investments should not be offered as security for securing any loan. They should be free of any charge or they should not be made security for any loan. And these deposits should be used only for redemption of debentures. Okay. This again is a safety valve. At least 15% is available in liquid asset. In case the debenture redemption happens, immediately 15% can be paid. So if you are a financial controller of a listed company, unlisted company, you should ensure that this deposit has been maintained. Please remember, this is applicable only to unlisted companies which are going for private placement, right? Even an unlisted company can go for a public issue of debentures, and these debentures can be listed, but that will not make it a listed company. Only if shares are listed, it will become listed. But you can go for credit rating and you can issue public issue of non-convertible debentures allowed. So ABC Limited, an unlisted company, issued 1 lakh partly convertible debentures of ₹100 on 1st October 2017 on private placement basis. So unlisted company private placement. Out of rupees 100, 75 is convertible into equity shares. And rupees 25 is redeemable on 30th September 2021. So we are now in the 21-22. I'm sorry, 2021. 2021. Now, on 30th September 21, I'm going to redeem these equity shares. I am there on 31st March 21. What is the amount to be transferred to DRR? 10% of the value of outstanding debentures as on 31/3/21 should be transferred to DRR. What is the amount outstanding? Only to the extent of I have to transfer only to the extent of the non-convertible portion. The convertible portion I need not transfer. So what is the amount of non-convertible portion? Out of 100 rupees, 75% is convertible. 25 rupees is non-convertible. 25 into 1 lakh, 25 lakhs. On that 25 lakhs, 2,50,000, that is 10% should be transferred to DRR. Now, what is the amount to be deposited for financial year 21-22? Now I should see. On 1/4, I should see what are all the debentures maturing on or before 31st March next following. So these 1 lakh debentures are going to be maturing on 30th September 21, which is well before 31st March 22, next following. Therefore, on or before 30th April, on or before 30th April 2021, I have to transfer 15% of those debentures. Please note, only the non-convertible portion, only the redeemable portion I have to take, because that 75 is going to be converted into equity shares. No bother. Only for the remaining 25 into 100, 25 lakhs into 15%, 3,75,000 has to be transferred to deposit on or before 30th April 2021. This is the approach. Right. Now, my dear friends, I have come to some sort of a conclusion of this topic. Share capital debentures. Today, we could have taken up acceptance of deposits, but I thought I will as well open up for questions which have not been asked in the query pad, which you can ask now. Any questions are there? You can ask me now. Now you can even put it in chat if you want. I will look at the chat now. Are you? Yeah. Any questions? If you want to take up any question on a topic which is not covered today, but relating to this topic also, you can take it up. Okay. Shall I take it that there are no questions? Yeah. Yes. Who is raising the hand? Mr. Anup. I think you have to unmute yourself, sir. Yeah.
Yes, sir, yes.
Now you can talk.
Hello, sir. In the last
Yes, sir.
example you have given us, sir, for DRR.
Yeah.
So
Yes,
DRR for investment purpose every year 15%, na, sir?
Correct, sir. Correct.
And in that last example, debentures was issued on 1st October 2017.
Correct.
So fully it was redeemable on 30th September, na sir. So on 31st March, matlab on 30th April 21, we are creating 15% of it. Or every
We are
year we should
transferring
create.
15% to deposit.
No, sir. It should be done every year till 21 or on 21 full.
No. Your point is well taken. Every year you should see what is the debentures maturing on 31st of March next following. Then you have to
Oh,
top it up.
yes.
Every year you need not to 15%.
Which
You
are
should
being
see what is the
matured.
15%. What is the already amount available in deposit? In case it is not sufficient, you have to top it up.
Oh,
You understand my point, now?
yes, yes.
Your question is, I think I've understood now. So you calculate 15% and see whether that amount is there in the deposit. If it is not there, top it up. At any point
Yes.
in time, this amount should not go below 15%. That's all.
Yes. And in case of buyback, sir, buyback can be done from in way of ESOP, sir.
Okay.
And how it can be done from open market, sir? So because if I buy from open market, I am a equity shareholder only, na sir, existing equity shareholders. So
Correct.
how? Then how, sir?
No,
Three options they have given: equity shareholder, open
the
market.
three options are mutually exclusive options. Meaning,
Oh,
if you are going to do pro rata buyback, what you will do is, see, normally what they do is they do a pro rata buyback, which means they send you an offer letter by which they say, in case you want your shares to be bought back, please send us the confirmation. You offer those shares through your broker, you offer it, they'll buy it back
yes,
proportionately.
yes,
Proportionately.
yes.
Whereas open market means what they will do, they'll ask their brokers to buy. Anybody can come and sell any amount. There will be no
Oh,
proportionate there.
uh-huh.
So once the quota of buyback is over, they'll stop buying.
Okay.
So if I want to sell my entire holding also, I can sell.
Sell.
Whereas in pro rata, what happens now? Only proportionately. Suppose I have 100 shares, they'll buy back 5, like that.
5.
Right. ESOP is different. Only employees are entitled to that buyback. So that will be by a separate letter. They will be asked to offer their shares.
Shares.
If they want, they can opt and they can sell it back to the company.
Okay, sir.
But it
Thank
won't
you,
be
sir.
compulsory. You can't insist that the employee should sell.
Yes.
If he wants to retain, he can retain also.
Okay, sir. Thank you, sir.
Okay, good, Mr. Anup. Thank you. Because you see, now I'm caught in a little bit of a trap. Yeah. Where I have only 15 more minutes. But I can't start the new topic also now. So if any more questions are there, you can ask. Even from an earlier topic, you can ask questions. In fact, how to join through Zoom, many people are asking. My request is you send a mail to the institute. They will give you the guidelines on how it is to be done. Okay. On the Kavita ji, on the convertible part, there is no need to create any DRR or any transfer to thing. Only on the non-convertible portion, you have to create DRR and thing. On the convertible, nothing. DRR is 10% on the non-convertible part. Means on 31st March, you have to see what is the total amount of debentures outstanding, non-convertible part. Make 10% DRR. Then before 31st March next following, how many debentures will be redeemed? To that extent, you have to create 15% deposit. If deposit is already there, you just top it up. If not, make a fresh deposit. That is all. Okay. Thank you. And any other questions? Anything? In fact, I'm very happy. Earlier, I never used to be able to talk to students. It was always through QueryPad, that I will get it. But luckily now I'm having an opportunity to talk.
तो मैं दिखाऊंगी वैसे
हाँ, देखो देखो होने लगा.
Yes, madam.
हेलो
Okay, Rashmi, you want to ask me a question?
सर सर वॉइस
Sorry? Okay, no problem. And it was great. Nice evening. I will keep open for another 5 minutes. In case you want to ask any questions, you can ask me. Sir, Mr. Ajit Kumar. Okay. Since there are no more questions, I will look for any questions in chat and query pad. In case there are no questions, I will stop. Thank you for the nice words, Ms. Rohani. And no problem. Thank you. I'm at this point in time, I wish you all a good evening and look forward to. Okay, I don't have a quiz. Let's see if I have a quiz with me for share capital and debentures. Yeah, I will see if I have. If I have, I will definitely. Start. 1 second. Just give me 1 minute. I had some quizzes, but I see if I have for this. Let us see. 1 second. Give me 1 minute. Just give me 1 minute. I will share screen in 2 seconds. Since, as you say, we got 15 minutes, I have some questions I can show you and we can discuss that. Just hold on. Share capital. Yeah, I have a quiz with me. Let me just open up that quiz. If you are interested, I will go with the quiz. Okay. I'll just take a quiz. Okay. Yeah. Okay. So you can give the answers in the query pad. More of testing your knowledge. Yeah. Muhammad Abdal. Yeah. If the dividend on any, even orally you can answer since we are connected on Zoom. If the dividend on any class of shares is not paid for dash or more, then every preference shareholder of such class has a right. 2 years. B is the correct answer. Beautiful. Beautiful. See, some of these questions I might not have covered today. Okay. Offer of further shares by a company to all its existing shareholder in proportion to the paid up share capital held by them is called
Right issue.
correct. It's called rights issue. Actually, it should not be a right issue. It's a rights issue. That's okay. No problem. Rights issue. Correct. Bonus issue is where we allot shares free, fully paid up. We capitalize the reserves. We convert the free reserves and securities premium into shares. Whereas rights issue is where he actually has to pay for it, but he'll get it in proportion. Okay. Sometimes the price is lower than the market price. Sometimes, but not always. Public issue is where we go for full price. Okay. A company issued 10% dividend shares with the right to participate in surplus profit every year. Though these shares does not have preference of repayment of capital, but they have preference of payment of arrear dividend at the time of winding up. These shares are called, they are basically DVR shares, differential voting right shares. Okay. So they are basically called differential voting rate. So they have differential voting rates. They're getting more dividend. Okay. for debenture redemption reserve, which of the following statements is least likely to be true? NBFC should make DRR equal to 25%. Not true. NBFCs need not make DRR. A company should make DRR equal to 25% for any allotment of debentures. No. DRR should be created out of profits freely available for distribution of dividend only. Correct. C is the only correct answer because DRR should be created out of profits. Meaning, once the profit for the year is determined, the DRR should be created out of the profits for the year, which is post-tax available for dividend. Only that amount can be used for DRR, creation of DRR. This was not taught by me. Let us see whether anybody can answer. Yeah, 4C is correct. 5. Let's see if anybody can give an answer. Otherwise, you have to go back to my lecture and see the lecture on transfer of securities. Allotment
Sir,
of...
I guess the
Yes,
answer is B.
B, where a public company refuses to register transfer
For
of any
30 days.
but does not send any notice of refusal. The transferee may within a period of 60 days, that is 30 days, they have to give a notice of refusal. If this is a transmission, it is 90 days. For transfer, it is 60 days from the date of delivery of the transfer deed. Okay. For transmission, it is 90 days. Okay. Great. Now, sorry, this is little, I don't know what is the... Size is not coming correctly. Once you just give me 1 minute. Try to reduce it. See, it has bought back its equity shares in March 2020. It wants to buy back further 10% equity shares in April 2020. Can it do that? Gokul irukala.
Yes, sir.
Yaar?
Sudhakaram, Suresh ಅಲ್ಲ. Sudhakar வெளில போயிட்டாரு. Suresh.
Yeah.
Sir, can you repeat the question?
Basically, the company made, see, something is missing. It's not there. I'm reading it. The company made buyback of its equity shares in March 2020. But now it wants to buy back further 10% equity shares in April 2020. See, the logic is it looks like it's the next financial year. Can it do that?
It cannot.
It cannot.
Sir. Period of
Because
12
the
months
gap,
is required.
yeah, there must be a gap of 12 months between two buybacks. It's not as if you can buy back in every year 10%. No. No. It's like once you make a buyback, either 10% or 25%, from the date of completion of the buyback, minimum 12 months should be there elapsed before you can make another buyback. So the answer is B. It can't. The D is not correct, though it says it can't, because the reasoning is wrong. The reasoning is wrong. Whereas B is the correct answer. I'm so sorry, it's not. So a company has a share capital of 5 lakhs and a loan from government of 2 lakhs. Government ordered the company to convert its loan into shares. Okay. In this case, such order has the effect of increasing which capital? It will increase all of the above. It will increase the authorized capital. It will increase the subscribed capital. It will increase the paid-up share capital also. Right. Now, once the government passes an order for converting its loan into shares, the GO will have the power. Because after all, who is the government? Yeah, it is the ministry or whichever ministry it is. They have the power. So that order will have the effect of increasing authorized, paid-up, and subscribed capital of the company.
I don't think authorized capital will get increased
Okay.
because authorized capital will get increased by payment of the filing fees,
See, all
the
that you
board
have to do it.
resolution.
Correct. No, the point, yeah, I agree with what you're saying. See, this will have the
Who is
effect
the
of
BOS faculty here? Srikant
sir.
sir.
Yes, sir.
This
Yes,
is
sir. You
Rajkumar
feel that authorized
Adukia.
share capital cannot be increased?
No, I am asking who is the BOS faculty here.
I'm not aware,
Good
sir.
evening, sir.
Good evening. आपका नाम लिखो ना, please.
Okay, sir. I
What
will
is
write
your
it.
name, please?
Sir, I'm Shraddha. CA Shraddha, sir.
हाँ तो CA Shraddha, authorized capital on its own cannot increase. Authorized capital requires a resolution of board of directors, the approval of the shareholders, and the filing fees.
Rajkumar sir, Srikanth here.
हाँ,
Basically, the concept is like this, sir. When the
we will
government has
not
passed an
debate.
order,
We will not debate. Let me examine.
yeah, please, we'll
Because
go through it. Maybe I will also check up and get back to you on this, sir.
because there are certain processes. See, within anyway, we will not
No,
debate
no,
on
it's a
this.
good. You are making a valid comment. Let me also verify and get back. But let me make one point here. When the government passes an order, the shareholder should not refuse to pass a resolution. That is the
No,
point. We are.
but that they will not refuse, sir. But the
Hmm.
process has to be completed, na. Automatically, authorized capital cannot increase, na. See,
Okay.
for
We will definitely go through it, and I'll get back to you on this, sir.
हाँ.
I will go through that particular section, and I will get back.
And Shraddha ji, my request is all POS faculty should write the name also. So participants will know that, okay, this person is there. CS Shraddha is there. This we are taking intermediate accounts, advanced accounting, or final
No, sir.
account.
This is company law, corporate and other laws.
Okay, of intermediate.
Intermediate. This is share
Paper
capital
2.
in debentures. That is why it looks a lot like company accounts.
No, paper 2.
Paper 2.
Okay.
That is why it looks, because it's share capital in debentures, there's a lot of overlap between this and company accounts.
Yeah.
A good point, sir. I will definitely get back to you on this. Okay. If there is a change of right of one class, then which will also affect the right of other class, then consent of 3/4 majority of that other class should also be obtained. Today we have gone through it. Shares which are issued by a company to its directors or employees at a discount. If you remember, discount shares can be issued at a discount only to directors or employees. They are called sweat equity shares. Right?
Sweat equity shares.
Correct. Absolutely correct. I'm sorry. There's some problem with the thing. Anyway, the time is up. It was nice to have Mr. Rajkumar Adukia here. Great, sir. And because it's a long time since I've yeah. If nobody has any other doubts, let me take it that we can call it a day. Wishing you all a very good evening, and thanks a lot for being here. Thank you, sir. Bye.
Thank you, sir.
Thank you.
Thank
Good
Thank you,
night.
sir. Thank you, Chairman, sir. Thank you, Shrikant, sir.
Thank you,
Thank you,
madam.
students.
Yeah. Can you disconnect me, madam? I'm unable to get out of this. Yeah. Yeah, okay, sir. We can close the meeting.